Every 20 seconds, the US national debt grows by nearly $1 million, and by $1 billion every 5.5 hours. As we speak, the debt clock is spinning faster than ever. The US is spending like it's in the middle of catastrophe. Yet unemployment is nearly 4% and the economy continues to grow. Sounds strange, right?
It does, but then again, what doesn't these days? Just look at what's happening in the world, in the White House and in the people's minds. Strange almost feels like a polite way to describe it all.
Even with all this economic sunshine, Washington still ran a $1.9 trillion deficit in 2024, a staggering 6.5% of GDP, levels typically seen during pandemics or deep recessions. Meanwhile, the national debt has soared past $37 trillion, now sitting at 120% of GDP, the highest since World War II. So why is the US drowning in red ink when everything seems fine? Is it a ticking time bomb ready to explode on future generations, or just another scary number tossed around by politicians? The truth is more twisted and more urgent than you think. Hit that like button, subscribe, and let's find out if the US budget deficit is truly dangerous or dangerously misunderstood. America hasn't balanced its budget in over 20 years.
In 2024, the national debt climbed past $35 trillion, pushing the debt-to-GDP ratio above 100%, the highest since World War II. Unlike wartime spending, today's deficits are driven by long-term structural obligations rather than extraordinary events. The core of the issue lies in mandatory spending, which consumes 62% of the federal budget. Social Security makes up 19%, Medicare 12%, and Medicaid 9%. As the population ages and healthcare costs rise, these programs automatically expand, regardless of economic conditions or political decisions. Interest on the debt is becoming a major burden, hitting 2.5% of GDP in 2024. With elevated interest rates, projections suggest it could reach 7.5% of GDP within 3 decades. Discretionary spending, which includes everything from defense to education, represents just 27% of the budget and offers limited flexibility.
In short, rising costs and shrinking options have locked the government into an unsustainable path. The growing deficit isn't just about overspending, it's about structural imbalances that deepen every year action is delayed. What do you think? Can the US fix its debt crisis? Or is it already too late? Share your thoughts in the comments below. Back in 1946, US debt stood at a staggering 120% of GDP, close to today's levels. Yet the country rebounded with explosive post-war growth, fueled by industrial expansion, rising productivity, and a booming workforce. Debt shrunk steadily as a percent of GDP, not because of drastic spending cuts, but because the economy grew faster than the debt. But today's fiscal landscape is very different.
Starting in the 1980s, a new pattern emerged. Reagan's sweeping tax cuts and Cold War defense buildup drove deficits higher. Then came George W. Bush's wars and Medicare Part D. Obama responded to the 2008 financial crisis with a stimulus package. Trump slashed corporate taxes, adding an estimated $1.8 trillion to the debt over a decade. Biden followed with massive infrastructure and pandemic spending. The result? A debt that now exceeds $37 trillion, or about 121% of GDP. But unlike in 1946, America today faces an aging population and rising healthcare costs. Social Security and Medicare are consuming an ever larger portion of the budget. At the same time, interest rates are no longer near zero. In fact, net interest payments hit $900 billion in 2024 and could reach $1.4 trillion within a decade.
And here is the twist. All this is happening during peacetime and low unemployment. There is no war in the US. No major crisis, just massive routine overspending. That's what makes today's debt different and far more dangerous. The past may offer lessons, but it's no longer a guidebook. The rules have changed. When people hear about the huge US national debt, their minds often jump to sorry headlines. Hyperinflation, China dumping treasuries, or sudden financial collapse. But according to leading economists, those aren't the most immediate threats. The real risks? Complacency.
In 2024, the US ran a $1.9 trillion deficit, despite low unemployment and economic growth. Historically, governments save during good times and spend during crises. But today, America is doing the opposite. running crisis-level deficits in calm waters. Even more alarming, huge interest payments on the debt quietly overtaking the entire defense budget. Unlike entitlement programs, this money doesn't go to citizens, it just services the interest. The Federal Reserve's recent rate hikes mean the government must refinance its debt at much higher costs. If rates spike further, or if investors lose confidence in U.S. fiscal responsibility, it could trigger a chain reaction: soaring borrowing costs, falling bond values, and a drop in the dollar's strength. China or Japan suddenly selling off U.S. debt wouldn't cause a meltdown by itself, but if that move coincided with political gridlock or a default scare, it could shake global confidence in U.S. credit. As Maya McGuinness put it, the debt doesn't matter until it does, and by the time it does, it's often too late to act without pain.
Yes, Japan and Italy carry higher debt to GDP ratios than the United States, but neither anchors the global economy. The US dollar holds the world's reserve currency status, used in over 80% of global trade and trusted as the safest store of value. This unique role gives the US an exorbitant privilege. It can borrow massive sums at low interest rates simply because the world trusts it will pay them back. But what if the trust begins to erode?
A true default, failing to pay interest or principal, is extremely unlikely. Yet even a temporary delay in payments, caused by political standoffs or debt ceiling brinkmanship, could rattle global markets. If investors begin to doubt America's ability or willingness to manage its finances, they could demand higher interest rates or shift to alternative assets, driving up borrowing costs and weakening the dollar. And that affects more than Washington. A weaker dollar would mean more expensive imports, shrinking savings, and higher inflation for American families. Adding to the instability, Donald Trump has recently questioned the legitimacy of official U.S. debt figures, claiming without evidence that the numbers are fraudulent. While likely political posturing, this rhetoric undermines the credibility of U.S. fiscal data and could shake investor confidence. Even if the U.S. government fired every federal employee tomorrow, it would only save about $270 billion, barely a dent in the $2 trillion annual deficit. Symbolic cuts, like eliminating funding for public broadcasting, save mere billions. Meanwhile, former President Trump's new tax proposal, dubbed the Big Beautiful Bill, adds an estimated $2.4 trillion to the deficit over the next decade. That's before even factoring in interest payments. The bill proposes extending previous tax cuts while offering new breaks for seniors and workers. Spending cuts included in the plan? Roughly $1.3 trillion, mostly from healthcare and green energy programs, nowhere near enough to offset the loss in revenue. Serious proposals like the Simpson-Bowles plan have been floated before, suggesting a balanced approach. Raise the retirement age, trim entitlement growth, and increase taxes. But those ideas remain politically radioactive. Polls show most Americans want the debt reduced, but not through tax hikes or benefit cuts.
That leaves lawmakers with a dilemma: either embrace unpopular choices now or face far more painful ones later. So, is the US budget deficit truly a ticking time bomb, or just a scary number on the screen? Here is the reality. The debt is sustainable for now. The US still benefits from a strong growing economy and the dollar's role as the world's reserve currency. Investors around the globe continue to trust US Treasury bonds as safe assets, which keeps borrowing costs relatively low, but that trust isn't guaranteed forever. What worries experts isn't today's numbers, it's tomorrow's trajectory. Interest payments are rising rapidly, entitlement costs are growing, and tax revenues aren't keeping pace. The real risk is complacency. A sudden political crisis over the debt ceiling or global investors losing confidence could trigger a financial crisis, soaring interest rates, a plunging dollar, and a government forced to slash spending or raise taxes overnight. The deficit won't crash the economy next week, but continuing down this path, especially in times of economic strength, leaves the US less prepared for the next true emergency. In short, the US budget deficit isn't an immediate disaster, but the longer we wait, the more painful the reckoning will be. Is the US economy built on trust or on borrowed time? Share your thoughts in the comments below. Also, don't forget to hit the like button, subscribe and share this video so you won't miss our upcoming content. Catch you in the next one.